Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Welcome to this HC Commodities Podcast live event. Thank you all so much for coming and braving downtown traffic at this hour. First off, I'd like to thank our sponsors, 61 Commodities, Phillips 66 and Bridge Alternatives, and we've got representatives there from those companies here tonight. To introduce myself, my name is Paul Chapman. I am co-global head of HC Group, a search firm dedicated to the commodities sector, and the host of the HC Commodities Podcast, as now is. A couple of bits of housekeeping. So the panel will run for about 45 minutes, give or take, and then we'll turn the mics off and allow for some questions, and hopefully that means our panelists can be a bit freer. Tonight we're talking about the US natural gas in a global market. Over the next 2 years, it's forecasted an extra 12 or so billion cubic feet per day of LNG is going to be exported primarily to Europe. What does that mean for the US natural gas market? What does that mean for the European market? What does that mean for the global market? And what does it mean for the traders and the teams involved in this sector? Here to tackle that question is our panel. Delighted to introduce Nathan Arentz, Managing Director at Skylar Capital Management. Nathan's over from London. Anne-Sophia Corbeau, a global research scholar at the Center on Global Energy Policy. We've then got Harrison DiStefano, Chief Commercial Officer at 61 Commodities, and finally Graham Fisher, Head of Natural Gas Trading at Phillips 66. And we have a lot to get through. So I guess, Anne-Sophie, can we start with you? And can you just lay out the landscape for us in terms of global gas flows today, and indeed what the world is anticipating in terms of US exports and where that might go?
Thank you very much, Paul, and good morning, good evening, or late afternoon, actually. Sorry, I am a little bit, I am coming from Europe, so I don't really know what time it is. So we are looking at a totally unprecedented number of LNG liquefaction plants which are under construction. The volume is tremendous, I mean, I used to compare the waves of LNG. The first wave was the Qatari one, roughly about 100 billion cubic meter. Then there was a US and Australian one, 2015, 2019, about 200 billion cubic meter. The one that we are looking at, which is going to be between now and 2030, is about 320 billion cubic meter. So don't tell me that there is no LNG under construction. And yes, there is about 100 billion cubic meter which is coming from the US. So we have plenty of LNG coming to the market. With some caveats, you can talk about a certain LNG project which is right now trying to send LNG to, I don't know where actually. The boats are going, making rounds on the water. That one may not go very far. But for the others, this is pretty much committed. There will be delays because this is what happens in the LNG business. Now, I'm sure as a European, you want me to say what I'm thinking about Europe, right? Well, our dear market has lost about 20% of its volume between 2021 and 2023. And it's funny, everybody, since I arrived in Houston, seems to be picking at Germany. Well, I mean, it's kind of general. Yes, Germany is a very good example of what is happening in Europe. There have been some demand destruction there, but I can assure you the demand destruction is happening pretty much across all sectors. In the residential sector, people have learned, that actually, the thermostat at 19 degrees is as good as the thermostat at 23 degrees, You just put an additional sweater and you're fine. Demand destruction in the industrial sector, that's a little bit more worrying. But the good news is that over the first half of this year, we have actually seen demand rebounding by about 7% year on year. It's still about 18% below where we were in 2021. But where we are still continuing to see demand destruction is in the power generation sector, because we are seeing growth of renewable. Nuclear is finally stable, actually even increasing in France. And also we have very comfortable hydro levels. So thermal generation, both coal and gas, is simply coming down. Now, what does that mean for the LNG flows which are coming to Europe? So we had a big increase from 2021 to 2022. And everybody, I know everybody, probably a lot of the Americans here, because I got a lot of phone calls in 2022, was looking at Europe thinking, this is a new market, this is fantastic. Why are the Europeans not signing long-term contracts? Well, because the Europeans have been told by the European Commission, you can't have a long-term contract going beyond 2049. This is in the new gas and hydrogen package. Well, some companies have actually said, we don't really care. We are going to sign long-term contracts up to 2053. This is the 3 companies which have signed a contract with Qatar. And also fundamentally, when you are looking at what is going on in Europe and this strive towards decarbonization, you are thinking, well, do I want to sign a long-term contract? Do I want to be locked and not knowing exactly what is going to happen to my demand? Well, maybe not. That's why a lot of European companies have been very hesitant. And when you are also looking at the European Commission forecasts, which are really, really low in terms of gas demand, by 2030, you're thinking, maybe I don't want to commit myself.
Yeah, that's going to be an interesting part of the story. Just before we kind of come on to, and I don't know if anyone wants to jump in there, but I guess before we come on to that global demand story, which, as you say, has disappointed somewhat. Just on the supply side, like Graham, over to you. I mean, this is your neck of the woods and Harrison's. If you're going to export such a large percentage of or a significant percentage of US current production over the next 2 years, can supply meet that potential export demand from an infrastructure standpoint and so forth? I mean,
Sure. Yeah, I can take a stab at that one. So it's interesting because Anne-Sophie described the LNG market, and in terms of the U.S., it's viewed really as a supply. But in the U.S., we would view liquefaction; it's on the demand side of the equation. And so currently liquefaction capacity in the U.S. is around 15 BCF a day of liquefaction capacity. And if you're thinking about what the U.S. market looks like, say by the end of the decade, LNG is the big story there. So in terms of, by the end of the decade, you include Canada, include Mexico, because LNG in Canada and Mexico will impact our imports and exports. Maybe an incremental 15 BCF a day of LNG liquefaction capacity. On top of that, there's additional growth in terms of the U.S. You've got general electrification going on. There's a lot of talk on data centers with AI, and there's a lot of different expectations of where how much demand that's going to be. On top of that, there's a lot of industrial facilities that are getting built. Thinking that are going to consume a lot of gas. So think methanol, ammonia facilities, and really that's just another way to export a hydrogen molecule. Lots of growth there. And then I'd also add in growth in Mexico. We've got excess capacity going to Mexico, and certainly the exports to Mexico over the next several years are going to grow. So, 15 BCF a day in LNG growth, and then, there's probably a lot of wild estimates out there, but maybe an extra 5 BCF on top of that. So you're looking at a picture of really between now and the next 5 years, we're going to have to handle growth of about 20 BCF. So where is that going to come from? How is production going to be? Where is it going to be produced at? And will production keep up? And so, really when I think about that, I'd probably put it in a couple categories, and there's different dynamics. But one side you need price to incentivize production, and then the other thing, depending on where it's produced, you're going to need pipeline takeaway. So I kind of think about them differently in terms of there's dry gas plays. There's associated gas plays, and then it's probably worth mentioning also Canada and what's going on in Canada with LNG Canada coming up. But on the dry gas plays, the 2 big basins there, Marcellus Utica and Haynesville. So Marcellus Utica is 35 BCF. It's about a third of U.S. production today. Massive growth over the last 10 years out of that basin. But really they've been able to use existing infrastructure, reverse pipelines, things like that as productions come up. In terms of can that basin grow over the next 6 years, it's probably going to be challenging. And a lot of that's just based on pipeline takeaway. From a price perspective, cheapest U.S. gas is in Marcellus. It's the largest reserves in terms of gas is in Marcellus. But from a takeaway perspective, I think it's going to be tough to build a pipeline. And that's really, you're going to have permitting reform. You know, a pipeline of that magnitude, maybe a $5-6 billion project. And we all know that how hard it is to get pipelines built. On the Haynesville side, it's a little bit different dynamic. You're closer to LNG in the Haynesville. You're closer to the growth. There's a lot of pipeline infrastructure there. It's a shorter pipeline build. So I think it's probably more realistic that over the next 6 years, pipeline takeaway out of the Haynesville could happen. But, you know, from a price perspective, it's more expensive gas. So in terms of Haynesville, you know, we're here maybe 375 is needed really to justify production growth there. But I think Haynesville is certainly going to be a big portion of the growth. Now on the associated gas plays, that's going to be kind of your Mid-Con area, DJ, Powder River, Oklahoma, obviously the Permian and Eagle Ford. And really there, you got pipeline takeaway and then you've got also price, but the price dynamics there are really based more on the crude.
And oil.
And so if crude grows, then you're going to see associated gas. And so which basins grow there, it's based on where the producers want to drill for crude, not where they want to drill for gas. And so what you're going to see is, you know, DJ Basin, Oklahoma regions, probably are going to stay flat. It's probably not going to drop, but you're not going to see meaningful growth towards this 20 BCF number because the producers are putting all their capital to work in the Permian and also in the Eagle Ford. Now, 20 BCF is a lot. Can we keep pace? So that'd be a question. I think over the last 6-7 years, we've had 4 BCF a year would be, over the next 5 years. I think we've kept pace with 4 BCF where it shouldn't be a problem. But between now and the end of the decade, there's a lot that could happen. So not sure if we can hit 20 BCF or if we will or what it would take to do that. But I think in terms of, if you look at it next year, exit 2025, we know what's starting up, when it's starting up. I think LNG, you'd probably say maybe 4 BCF incremental export capacity by December 2025. And it's like, can production go up by 4 BCF? And it's like, well, today we're at 102 BCF. So we need to be around 106 BCF by the end of 2025. And it's like, well, there's voluntary curtailments today. So that gets lifted, it creates. There's coal to gas switching. That might be a couple BCF. You've also got producers that have drilled their wells, but they haven't turned them on yet, turned in lines. And one producer said that they have a BCF of capacity ready to go when the market needs it. So I think in the near term, it shouldn't really be an issue.
We were joking beforehand, it's either $1 or 10, right? I mean, there's a lot that needs to happen, a lot of events that shouldn't happen to do that. I mean, Harrison, what's your view?
Well, the 1 versus 10, or maybe 1 versus 15, is something we talk about a lot at our office, which is how binary the U.S. natural gas market is right now, right? We came from 2 years ago where we didn't think we had enough gas supply to meet demand. LNG exports were running at nearly 100% capacity, coming off 2 years prior where they were at times running at 50% capacity, in some facilities even less. And then we haven't talked yet about renewables, right? We've doubled the amount of solar in the United States in the past year, and we're going to keep growing solar over the next decade, and certainly in the next few years of all the projects that are already being built. And what does that mean? Well, the solar is not economically dispatched. The solar is dispatched when the sun's out, and maybe if the batteries can actually take that solar and move it around the hours. But what happens? So gas is solving that problem now, and gas is going to continue to solve that problem in the future. But we're talking about new pipelines from the Haynesville, and they may get built. One of the things we haven't built in the last decade, or maybe longer, is storage. So we haven't built storage in the United States to deal with these potential swings of LNG that we just talked about, the swings of renewables that come and go, the shoulder seasons in the U.S. that naturally need the storage. And we've grown something like nearly 80% in the last decade of natural gas production. We have 4.1 TCF of probably workable storage then. We have about 4.1 TCF of workable storage now. And so what does that mean for U.S. traders? It means volatility, I think. And I think it means that what's happening in the global markets when that demand isn't growing as fast as some of these LNG projects as they come on in big waves. Does some of that LNG need to get turned back in the shoulder seasons in the summer? And does that lead to additional volatility in the U.S.? We think it does, and we think we've seen that. But not only that, the volatility in regions, right? Where gas is going to get backed up, where it can't get out of basins, you might see production growth in the Haynesville. You might not, depending on price. But the regional dynamics, because of the lack of infrastructure builds, I mean, MVP pipeline took, only 3 or 4 years longer than we all thought. And so I think that's going to lead to regional volatility as well. And so, I wish I could tell you if it's going to be 1 or 10, but I will tell you it's going to be 1 or 10, right?
Yeah. Lots and more volatility, more frequent, more intensive. Nathan, you've been very patient with us. Is it the same story in Europe, right? And globally, I mean, you've got a global view to bring to this picture. Is it more volatility, or could we essentially have no demand in Europe and actually all this LNG just stays, or natural gas stays in the US?
Look, it's a good question, and thanks for giving me such a narrow topic to focus on. But let's start with Europe. I think, actually, there's 3 probably buckets we should just mention straight away, and that's Europe, China, which is a demand center all of its own, and emerging markets is probably the one that's up and coming for the last 18 months. If we start with Europe, what we're seeing in Europe is, we're having a crisis, really, an energy crisis. And what's happened with that crisis is the market is completely transforming. It doesn't look like the same market it was 2 years ago. And in terms of what's going to happen in the future, very hard to predict. But what we do know is renewables have massively ramped up in the last 18 months, and we're starting to feel the impact of that. It's very hard to get sort of clear research on renewables and to predict the impact it's going to have on gas demand. But for instance, we are seeing it in real time. I think 2 weeks ago, we saw the UK, the first time in my 20 years of trading, to see the primary energy was brought to the UK by wind. It was 50% powered by wind, which was a bit of a shock when I saw that number going back 10 years. I never thought I'd see that to this day. So it's creeping up in the background. So Europe is, in my opinion, it is a market where demand has probably peaked for LNG. And if anything, we're going to see demand decrease or diminish over time. I think we're looking at peak LNG for Europe. That's interesting. But plotting the path of renewables is very difficult. But we do feel that we're at that peak. Saying that, in relation to what we're talking about today with the amount of new gas coming on, one place that does have the capacity is Europe. I think at the moment, we've got about 270 BCM of import capacity. By the time we get to 2030, it's going to look like 400 BCM, which in itself will probably be the whole annual demand of Europe, or the whole annual consumption of Europe. So we're going to have plenty of capacity. I think what will stimulate imports into that region is that we have a lot of storage. We have the same sort of storage that America has in terms of actual volume. So we do have that storage, and it's located, pretty much where these facilities are. So that's handy, but it's all going to be about price in Europe. If it's cheap enough, we're going to import it. And there is the case that, it might stimulate a sort of reindustrialization of Germany, which at the moment is deindustrializing due to the high prices. So then we turn to China. China, the demand is still strong. It's growing, annualized at 10%. Terminals are rapidly being brought online. I think the demand this year, lots of people said, oh yeah, heat wave, but when you actually look at the numbers, it's just sheer terminals coming on and more demand from right across the region there. I think China looks the way it looks in terms of the breakup of primary industry. It is actual industrial demand, and then, which makes up a lot of transport. Transport is a booming industry in China for LNG. It used to be CNG, and now it's moving towards LNG, and it's really a huge growth. And part of it is environmental too. China has pledged, to be, carbon neutral by 2030. That's just down the road. So they're really pushing hard to bring in, cleaner fuels rather than coal. And on the other end is the emerging markets, which a lot of people aren't paying too much attention to, but the likes of, people that you'd never think would import LNG. Philippines, for instance, who have their own domestic supply, now at a point where they need to import. And they're importing maybe 2-3 BCM at the moment, but projected to bring in 14-15 BCM by 2030. Vietnam, you've got Egypt. You've seen how they've gone from being comfortable with their supply to, not being so comfortable. Many of these small Asian countries. Thailand is a good one. It's now the 8th largest importer in the world for LNG, and 2 years ago it was nowhere. So I think, what we're looking at is, I think a lot of people are thinking, okay, it's Europe, but I don't think the demand is in Europe. It's definitely going to come from Asia. There'll be a primary basis of demand from China as it grows, because its population is growing, and it also wants to clean up its environment. India as well, same problem, wants to clean up its environment and growing population. And then you have the emerging markets, which are growing really strong. So I think, when we talk about this US gas coming on, I think a lot of that's going to end up in Asia.
Yeah, which is, I guess, is kind of fascinating, because the story was this wave of LNG was going to be inflationary for the US and deflationary for Europe. But what you were sort of saying there was, we're not going to see that demand from Europe to take all of that potential capacity up. So we're going to see low prices in Europe. But surely there's LNG competing, the Qataris and so forth, to supply that Asia demand. I mean, what's your reaction to what Nathan said, Anne-Sophie?
First of all, I want to come back on something that you just mentioned, about volatility. So yes, we have a lot of storage in Europe, but actually this is the only pillar that we have left in terms of managing the global market, because Europe used to play a very important role in the global gas market. It was a balancing market because of three things: a lot of storage, the interaction between Russian gas and LNG, that's gone. Whoa, we are still importing a little bit of Russian gas, but this is eventually going to go. And then also the interaction between coal and gas in the power generation sector, which is also disappearing progressively. The big markets in terms of coal-fired generation are Germany and Poland, but eventually this is going to fade away. So the shock absorber is going to be gone pretty soon. The only thing which is going to remain is going to be the storage, and I don't think this is going to be sufficient. And actually, I think in the US, you're also going to have pretty much the same problem with the coal-fired generation decreasing progressively, more and more renewable. So I think this is going to be pretty interesting in terms of trading capacity. And what we have also seen, which should be really on the forefront of people's attention, is the impact of the weather on water, on hydro generation. It has been varying so much. In Europe, one of the reasons why there was so much of a crisis in 2022, and people tend to forget about that, is the power sector. We didn't manage to reduce our power demand, our gas demand in the power sector, because we lost quite a bit of nuclear generation and also hydro. It was dry, there was a drought. And if you think about that, in 2021, there was a drought in China. There was also a record drought in Brazil. The volume just spiked in Brazil. I think we need to be very careful about that, the impact of hydro generation, and that's pretty much across the world. And it can go both ways, actually. It can go towards drought, and it can go towards too much rain. Right now, we are exactly in the opposite situation.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global experts network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
There's lots about what potential regulation is coming from Europe as well. That means that there's not going to be those price signals to float the gas in the right direction. There's a lot to cover in terms of, in this base case we're describing, the world works normally and there's relatively few events. But as you described there's now lots of sources of volatility, weather, geopolitics, and so forth. And just back to you, Nathan, and then to Harrison. One of the things, Nathan, that you were highlighting in our prior conversations to this is that actually the TTF itself in Europe is relatively illiquid. None of the producers are wanting to hedge. And you've got a lot of financial flows from CTAs, investors, and so forth. And there's a sense potentially that the risks in Europe are being underpriced. And if there is volatility, there's not really the liquidity even there to to support managing it?
I think what we were talking about at that stage is not so much the front of the market, the next 18 months, which is where the liquidity window is for TTF. Very high volumes go through, and it very much resembles the US market. That's fine. You can do big deals and hedge things. But what we're talking about in terms of these projects is we're talking about 25, 26, 27. 25 is okay, but once you get to 2026, 27, there really isn't a bid. And at the moment, the market is backwardated. So the market is acknowledging that we're going to get these volumes. But what we do know is from the people that have the projects, maybe they've contracted, but those people that have contracted haven't been able to hedge it because there isn't any liquidity. There's nothing trading out in that period. Although it's shaped and it's priced in a bit of a discount, no one has yet stepped up to the plate and started hedging this volume. So when that comes, who knows what's going to happen? But at the moment, it's almost impossible to hedge anything out the back. So, what we've seen is players in the US, okay, we're going to get in early and try and buy long-dated cal years, thinking that demand will go up, and what's happened with Henry Hub, the prices come off. So now they're stuck wearing losses, and I think people are much more cautious in Europe. We've got to get through winter 24 and winter 25. Winter 24 is just riddled with supply risk. We have two significant wars on our doorstep. One of them, very much related to energy, and we still have energy transiting through this country that's being attacked daily. So in terms of what's going on there, I think no one's really willing to do anything too much in the forward hedging until winter 24 is over and done with.
Harrison? Agree with that, I guess?
Well, I think there's a couple of fair points there. Number one, the TTF market is very liquid in the front, but it's not that liquid in the back. But the other thing is the TTF market is not the market for LNG, right? It's a domestic market inland, right? And so depending on times of need for LNG, is there enough spare capacity to import? Today, there maybe not. You said it's growing, and that could alleviate the problem. But that's not a perfect hedge, right? The other thing about deciding when you're going to hedge and what might be holding some back is regulation in the U.S. Are these facilities that I am now committed to for 20 years, are they actually going to get their permit and come on, right? Now, we have a few that we know are coming on in the next few years, but beyond that, there's a lot of volume that is it riskier to hedge or not hedge, depending on your view of the policy, which I'm not going to try to predict here. But I will say something that, Nathan, that was interesting you mentioned before is European demand potentially going lower, and we certainly are seeing that year on year. Load growth has been lower in the power sector. We obviously had the retracement of industrial demand and other general demand, which we're starting to see small recoveries of. But one thing that we're seeing a lot in the United States, and I'm hearing about more in Asia and Europe and India, is data centers. And we talked, we talk to data center developers on a daily basis now. And what they were looking for a year and a half ago was, where can I site a data center near a data line, or a fiber line, so that I can get, have that latency problem solved, right? Well, now they're looking for where can I find energy, right? And the number of data centers we're talking to, the number of megawatts that we're talking about is, in just a few companies we're talking to, are 5, 6, 7 U.S. Combined cycle gas plants, maybe 10, right? And Europe's not going to be falling behind in AI. You're going to build data centers in Europe. You're going to build data centers in China. You're going to build data centers in India. You're going to build data centers in Vietnam, right? And those data centers, they need power 24/7. Renewables do not solve the problem for data centers today. Now, they all want to be green, and they all want to buy renewable power, but the only real baseload supply that they can get up in any meaningful amount of time is natural gas. Nuclear would be a great option, but how long does it take to develop a nuclear plant, right? And so the rate at which that load growth happens and that demand for natural gas could potentially very much outpace the growth of renewables in certain markets could be what leads Europe to a higher demand scenario, right? But that demand is going to be, it's not going to be a straight up line, right? You're going to build that over time. And the question is, when do these waves of LNG come and meet that demand? And how much does that demand grow on an annual basis? And so there's a scenario where, we just look at the U.S. 2% load growth year on year in the U.S. in power does not sound like a lot. But we've come out of a decade of stagnant to even declining loads in the United States, right? We look at, okay, natural gas demand for power. Well, it should be going lower because we built all this wind and we built all this solar just this year. But we're making records, U.S., for natural gas demand for power generation. And even when you weather adjust it, the summer's closer to flat year on year, but the shoulders, or the winter season, is actually up significantly weather adjusted. And that's electrification of heating demand. That's really leading to some of the, we studied MISO just this week in the MISO region in the United States, the central region. The demand's up nearly a BCF there year on year just from heating of homes for wintertime. So I think we can't underestimate the electrification and the data centers in this demand story.
Yep.
And the other question I'll ask the panel, and you said 375 for Haynesville, right, to come on. Is there a month on the board above 375 right now? There's certainly not a strip, right? And so the price has to incentivize this production to come on, right? And this production, yes, some will come on probably this fall, right? That people have been hoarding, and waiting to complete and waiting to tie in. But next year, they're planning that budget now. They're planning that budget against, quite a low price. And are we going to see that growth of supply at this price? And when the market gets the price signal to actually drill, how long does it take for that to show up, right? And can the world just wait for that? Or are we going to see at times price parity with the U.S. because the demand worldwide and the demand in the U.S. match, and we have to have price parity in the U.S. Or is it the opposite, right? That the demand doesn't grow, or it doesn't grow as fast as we think, and we have these times where the U.S. Has to go into shut-in pricing like it did this March and April. And so we can debate all day long about how these things are going to happen. But what I do know is there's going to be these step changes in the market that I don't believe we have the infrastructure from a storage standpoint to handle. And natural gas is going to be a part of this mix for a long time. I'd like to hear one of you also tell me why volatility won't continue, because we're quite nervous that we're going to be in a very volatile market for a long time.
Well, let's just take for the moment, we'll come on to volatility, and I want to end on scenarios that could play out, because there is lots of sources of volatility. But just, Graham, I guess, to you on kind of that price signaling and how responsive US natural gas markets are. And then also something else that Harrison mentioned, which is obviously top of mind, is how these projects can and have been delayed. There's also a political dimension we probably won't get into here, but about whether they're going to continue to be permitted and so forth. So even that export itself is somewhat at risk from various factors, not least they're all based in Sabine Pass, which most years a hurricane rolls through. So can you just give us some sense of that price responsiveness and then some of the other things that could really change that game?
Yeah, sure. It's certainly easy to sit here and talk about, throw big numbers of growth up and when it's going to happen, but then at the end of the day, these are all physical assets. And not only do you need the liquefaction facility to come up, but you also need pipeline supply to come up, and you need production to come up at the same time. Earlier I mentioned U.S. viewing liquefaction as a demand, whereas the global market views the U.S. supply as a supply source. And I think if you think about it, this is really the only place in the world where upstream of the liquefaction you've got a very vibrant market and with their own supply and demand fundamentals, and then downstream of the liquefaction in the U.S. you've also got the same thing with an LNG market. And the supply and demand dynamics in the international market don't necessarily have to align, and they haven't over the last several years with what's going on in the U.S. But certainly there are times when it could. Post-COVID, you didn't need all the LNG, and the international price needed to come down to disincentivize exports out of the U.S. So trying to think through those scenarios, it gets rather complicated. But one scenario would be international prices were high, which we saw last year. Even right now, it's incentivizing exports. And from a U.S. perspective, if the international price is high, you're just in max export mode. All the LNG facilities are full, and from that as a demand in the U.S., that's what will price into the U.S. And it doesn't really matter. The other day, TTF was up 5%, and the U.S. didn't respond. It's because those markets are disconnected. But at times they may be connected. So another scenario might be U.S. gas goes up. And so U.S. gas goes up to $8. Well, the U.S. is such a large supply source in terms of global LNG, or it will be, that you should see a reaction in the global market. And then the other side would be, what if the global market prices need to come down to disincentivize production? If it's the U.S. that does that, that's going to be a pretty low price, because you think about the structure in the U.S., it's all contracted up. The liquefaction fee is contracted up. Many times the vessels are contracted up. And so that's all sunk costs in terms of the economics. And so the international price would have to get pretty low to say, hey, I'm not going to actually utilize this asset to send out to the market.
Yeah. Fascinating. I guess the question that kind of comes to me, and obviously relevant to us as in the recruitment world, is given all this, and given, of course, in 2 years' time or at the end of the decade, that connectivity presumably will have increased. Also, and that the same goes for global, right? LNG really starts to become sort of that global energy balancing mechanism for many of these economies. The question I guess I have, and we've got two teams here that are certainly global in terms of trading capability, is historically you could be a US gas trader, whatever region, you could, for the most part, ignore what was going on in Europe. Is that now no longer the case? Do you need to have, as commodity traders, as natural gas traders, as merchants, whatever role you might function in, do you need to have a view both domestically and internationally? Otherwise you're going to be missing opportunities and exposing yourself to unseen risks. I mean, Nathan, maybe you kick that off.
I think if you're sitting in Europe, you absolutely need a global aspect. And I've been privileged enough to work for the largest commodity trader in the world, and having a global presence was a major, major advantage. For various reasons, be it information. Trading is all about information, and having a network of information globally that can provide insight, regional insight, just means that you know things before other people know. And they're more relevant to you because you have experts on the ground telling you the significance of these bits of information. I think, secondly, with a global presence, what you do have is you're going to see more deals. You're just going to see more opportunities coming in from here, from there, and you'll be able to see what's a good opportunity and what's not a great opportunity on a global scale. I think it's absolutely necessary to have that global reach. And for me, I think that's moving more towards Europe, where the time zone sort of accommodates trading Europe, but also the US market, which is a short space of time and perfect for what we're doing in the afternoon. And also in Europe, you can access Singapore, and Singapore is an important market on the physical side, but it doesn't really have a financial aspect to it. It's about relationships. You have to be in that market if you're in energy to talk to people in that part of the world. But really, you've got these two big beastly markets, and I think if you don't have a global view, you're going to struggle about what's going on.
Yeah.
And it's even more important that if you don't understand what is happening in each specific market, you are going to miss things. So, when I was working for BP, I was interacting with the people in North America, I was interacting with the people in Japan, because the problem with natural gas, as I kept repeating to my boss, who was like, why are you, so precise about each country? Maybe you can do the modeling a little bit like, at a larger base. Well, no, I can't, because the problem is that natural gas, you need to understand what is happening in the residential sector, in the industrial sector, and most importantly, in the power generation sector. And in order to do that, you also need to understand hydro, renewable, nuclear, coal policy, etc. And that makes it very complicated. And if you do not have this kind of local knowledge, then you are missing things out completely.
Yeah, and one more to add, of course, and we saw this today in the news about Azerbaijan, is there's a lot of financial actors in this space as well that are CTAs and so forth that aren't looking at the fundamentals at all, right? There's lots of money flows coming in that can distort and amplify any trend that might happen. I mean, Harrison, obviously with your 6-1 hat on, global presence now a must for any gas trading business?
But we definitely have a global presence. And when we launched this firm in 2018, within the first year, we recognized that we had to be a global company to understand the U.S. natural gas market. The predictions of growth for LNG at the time, this was even before the Ukraine war, were quite robust. And so we launched our Singapore business in March of 2020, well before the war. But what I think is just as important as being global is something Graham mentioned. This is a physical market. right? And understanding the physical constraints of the market, understanding the behavior of the physical players in the market, what drives that behavior, whether it's economic, whether it's political, or in many cases, it could be a regime change, could drastically change the way someone will look at policy. I mean, I spent some time yesterday. I was fortunate enough to be invited to talk to the Indian oil minister and talking about the growth in India and talking to the people there about at what price do they stop burning natural gas and they start burning coal more. I mean, these are all very important dynamics, right? And these things, you have to know them. And so it's not just about having someone in the right time zone to be able to read a news story and analyze it. It's about having somebody talking to the people who are buying the molecules, talking to the people who are producing them and moving them and investing in the commodity. And so we strive to be that physical player, but I think there's so little data outside of Europe and the U.S. that can be very reliable. It's also the only way to really get data is by being in those physical markets.
Yeah.
Yeah, Paul, just one question. I think we certainly see, you mentioned financial traders needing to get physical or into the physical markets. We're seeing a lot of entities start up physical desks, staff physical desks in the U.S. Also, if there's several entities that have taken out commitments at these LNG facilities, and now they need to go and buy massive amounts of gas, and so they're setting up physical desks. What are you seeing from HC's perspective?
Moderator.
Yeah, and I'm curious if is this just, or to what extent is it companies coming into the U.S., or are you also seeing the same thing in companies going from the U.S. trying to get into Europe, trying to get into Singapore?
So I think the foundational trend, and there's some management consultancies that are definitely making some money on this, right? But essentially in the wake of, if you look back at 2020, incredible amount of volatility, incredible amount of, and there were oil majors out there that essentially survived that because they had trading capability, right? Then you layer in the energy transition, you layer in digitization, you layer in deglobalization, the kind of the big three themes that every commodity seems to end up at. And there is more necessity today than ever to be able to have a capability of managing that risk, right? And I think lots and lots of organizations are seeing that, from managing the risk, also getting closer to your customers, getting further down the value chain so you can see those changes that are happening in India or wherever it might be, so you're not blindsided by them. So I think as we look across and this is true of miners, it's true of producers, it's true of all physical participants in the commodity market. They're all trying to build out, to a greater or lesser degree, some better commercial capabilities. And I think we are seeing, and I've got colleagues in the room here, we're seeing European and Asian businesses coming to the US and building commercial teams, and you're seeing US businesses starting to think about, well, what do we need to look at in Asia, in Europe? I think a fundamental challenge, of course, is obviously the talent, how available that talent is, and also coming up with a very clear narrative. I'm getting on my hobby horse here, so I'll stop myself. But certainly we are seeing that trend. In the last 5 minutes before we start losing people, so there are two scenarios, right? We'll come back to that sort of $1 versus $10 US natural gas. I don't know, who wants to tackle the scenario where it's $10 US natural gas? And what might be one or two reasons that would lead to that?
Not me.
Cui bono, yeah. Go on, Harrison, you go.
Go ahead.
Yeah, well, I do think it's unlikely scenario at this point with the productive capacity we have in the U.S. that we'll see $10 prices for an extended period of time really ever in the U.S. again, or at least in the foreseeable future. You never say never. But in this low price environment that we've had in the past 2 years, we've still had times when the natural gas price had to get well above $10 in the short-term market to satisfy the balance, right? Just on that day or that week, right? Martin Luther King weekend this past year, Henry Hub traded up to 20, I think averaged $15 or $16 for that long weekend. That was satisfied because the LNG actually turned down and delivered molecules to the U.S. when it got to the price where they had the flexibility, right, to say, well, my price I'm getting in Europe is X, I can short load a ship, or I can delay something for a day or two, and I can deliver it. And I think the scenario where the U.S. Has to do that is most likely in the wintertime. If we actually ever get a cold winter again in the United States, I think you could see a time period for a month or two where you're competing with global markets to get to that $10 price or higher. But on a macro level, the productive capacity of U.S. production, the amount of gas and oil that can come out of the Permian, the Haynesville, while it's maybe needs $3.50 or $4 to come, if we get to $5 or $6 for a year, it's coming, right? And so I think that the scenario for the U.S. to be a high price is really more likely a short-term scenario.
Yeah.
But certainly not. I mean, we've seen it in the past year, so we'll see it again. I promise you.
Yeah, I'd echo that. It'd be hard to have sustained prices at $10 because producers respond.
High prices fix high prices.
Exactly.
Right.
Now, the one scenario I would think about, though, is there's a large amount of U.S. natural gas production that's associated gas, and that was what I had mentioned first. And so really, there hasn't been an issue for a while where crude prices didn't incentivize natural gas production. Like, U.S. is very advantaged on the crude side. But is there a world where crude production does come down in the U.S.? That would mean that U.S. natural gas production would come down, and it may be hard to respond.
I mean, the reason why we had very high gas prices in the international market in 2021 was because we had several factors contributing to that.
Yeah.
And you can very well imagine that in the US, you could also have that. Imagine very cold winters, hot summers, drought problems, and then you also have the buildup of the liquefaction plants. I mean, it's never one single reason. This is the accumulation of factors, and the fact that people don't really think, oh yes, I can have all these problems at the same time. But this is what happened in 2021. This is why in September 2021, we were at $30 per MMBTU on global gas market.
But I guess the point is, for it to be sustained at a high level, that seems the less likely scenario.
I am with them on that.
That would have to be a significant, all of these export terminals, stop, whatever it might be, right? That would be a different level of scenario, right, for it to be sustained. It seems that, at least what I picked up in this discussion, is kind of far more likely that the US is doing all this great work and is going to give Europe lots of cheap gas, replacing all that Russian gas, and prices will be lower, and there will be volatility, but in general will continue to be low in the US and possibly will lower in Europe as well.
Right now, we don't really think this is particularly low, but...
Look, if it's Europe, it's going to be a bad sell, basically, because there is no demand, and it's going to be a low price. It's right now we're sort of skirting along. Yeah, it's a high price due to a few factors, be it immense amount of financial money in the market. I think right now we're looking at about $25 billion sitting in the TTF market that is, giving it what we call a wall of bid, basically, at the moment. But the fundamentals are saying something different. But look, if this gas needs to come to Europe, it's going to be at a very low price. I think the next sort of price level it needs to sort of go to is lignite, which is dirty coal in Germany. And I'm not even sure lignite will exist in 3 or 4 years in the German market. So if that's the kind of floor where it needs to go through, it will just collapse right through that very quickly. And the next sort of stop for it is the marginal cash cost of US gas, which is going to be, $4 to $6. And if you look historically, that's what's happened, and I think, in 2010, 2008, that sort of region, I think it priced down to about 7. And then in 2016, when the projects started to ramp up again, it hit 11. And the recent low is about 3, and that was to do with the demand cycle of COVID. But nevertheless, they're not going to pay up for it. It's going to be a low price.
Well, glad I'm not a gas trader. Well, thanks very much to the panel.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.